like to say welcome to all of our online attendees and panelists. Thank you very much. Our webinar today is Lease Accounting, Are You Ready? It's part of our ACAUS International Accounting educational series that we're rolling out. Our series will include technical topics as well as soft skills for our international education program. And we're gearing this towards accounting professionals, within our membership and, potentially around the world. So we hope you do find this an interesting session, this one itself, as well as the program that we are rolling out. If you have any other questions about these sessions, as well as other ones that we're going to come up with, please get in touch with me, Executive Director at ACAUS.org, for more information. I guess I should have also started off and let you all know who I am. I'm Sasha Carlson. I am the Executive Director of ACAUS. And once again, we do welcome you to our webinar. Just a couple of housekeeping matters. While you're on the webinar, please do download the presentation that we've included on the handout section for your reference during the webinar. If you do have questions, please submit them through the question pane. We'll get through as many of them as we can in the question and answer session after our panel discussion, and any questions that we don't address, we will submit back to you following the webinar. A CPE certificate is provided. We're calling it a certificate of attendance because it's actually where we need our members to check with their accounting bodies themselves to make sure that the sessions do qualify. Credit for actual CPE with US state boards is currently being investigated. So before we start our official panel, I'd like to ask our panelists to introduce themselves. I'm going to start it over with Christy, and we'll move on from there. Hope you enjoy the session.
Hi there, my name is Christy Chenoweth. I'm the head of Technical Accounting, Accounting Policy, and Derivatives at Motiva Enterprises, which is a downstream oil and gas company here in Houston, Texas. We're wholly owned by Saudi Aramco, and I have about 15 years of experience in various technical accounting topics, but with about 10 specifically in commodity trading and derivatives.
Hi, I'm David Ray. I'm an Australian Chartered Accountant working with BHP here in Houston in a global policy role, so technical accounting role. In terms of my background, I've been with BHP for almost 2 years, but prior to that I was with PwC in Australia and in Indonesia.
Hi, I'm Stuart Studrum. I'm a chartered accountant from Scotland. I work for Centrica PLC, which is a UK utility company. I've been with Centrica for about 6.5 years, and prior to that I worked in standard setting for the European Financial Reporting Advisory Group, and prior to that I worked for BDO in Western Australia.
Hi everyone, I'm Jeremy Breekerhoff. I'm a Managing Director with CFGI. We're a accounting and finance consulting firm that assists companies with complex technical accounting and internal accounting positions. Prior to CFGI, I spent time as a technical accounting manager with a med device company, and then previous to that, I spent time with PwC Audit. I have over 10 years of leasing experience, with the last 2 years focused specifically on the new ASC 842 guidance, and I will be moderating today's panel. So we wanted to kick off the panel by kind of giving an overview of ASC 842, some of the key changes from ASC 840, so the existing guidance, and then kind of briefly touch on the general phases to an implementation. And so this will be an overview, but then obviously we'll get into some of the steps to greater detail as we go through the panel. For ASC 842. In its simplest form, what it's doing is the FASB's goal was to take the off-balance sheet liabilities that existed due to operating lease classification and bring it onto the balance sheet. And so ASC 842 accomplishes that, and by exactly that. And so even though the classification hasn't changed, so we'll still have operating leases and we'll still have finance leases, which is kind of the new terminology for capital leases in the US. No matter which classification you fall under, we will be capitalizing those onto the balance sheet. And so one way to estimate that impact would be to take your commitment schedule today and present value those cash flows. And that would be the amount that you put on your balance sheet as a liability with a corresponding asset. The effective date is January 1st, 2019, so this coming January for public companies, and then private companies have a year delay. The transition guidance is fairly favorable, and it allows companies to bleed off their existing leases for the most part under the existing guidance, so that you're just applying the new guidance for new leases, or if you have a modification to a new lease, or for modification to an existing lease, that's when you'd apply the new guidance. That being said, that transitional relief only applies to where you've assessed your leases appropriately currently. So where you under ASC 840, a couple of places where I've noticed companies have had to go back and reperform conclusions will be around assessing embedded leases, which we'll get into a lot in this panel, as well as reviewing renewal option conclusions. And the reason that this has happened is because under 840, if you're an operating lease, there is no impact to your balance sheet, and the income statement impact is about the same, whether you're including a renewal option or not, or whether you're identifying something as embedded lease or not. Whereas under 842, since it's coming onto your balance sheet, it just creates a focus on both your embedded lease assessment and your renewal option conclusions. And then I just want to touch briefly on an implementation as well. So the way most companies are assessing the implementation or performing the implementation, it's kind of breaking it up into 4 phases. The first being scoping and assessing completeness, which is where I would say most companies are spending a significant amount of time. Data validation, system implementation, which is another area which requires a significant amount of time, and then also disclosures. While there are key differences between ASC 842 and the new IFRS standard, and I know Stuart will get into that, many of the concepts and the amount of work that's required from an implementation perspective are quite similar. So I know I went through a lot there, and like I said, we'll get into greater detail throughout the panel. As I mentioned, the first step in implementation is going to be scoping and assessing your completeness, and that completeness includes real estate, equipment leases, embedded leases, and so I know Christy has started an implementation already, and so I wanted to get your thoughts on how did you approach the initial steps, including reviewing service contracts for embedded leases, and then also what sort of key considerations did you have?
Yeah, so we were really lucky. We'd been through a very large transaction last year, so we have a good handle on what our contracts are. And so one of the things that we've done is we've gone in and we've looked at every single contract and we've divided them into very large categories. Specifically, we know that we're going to have in our terminaling service arrangements, we have specifically identified tanks in a lot of those where we're both the lessor and the lessee. So that's one of our categories that we've identified. And in the other ones, we've identified anything where we have equipment service contracts where we may have an embedded lease, and then we have rail cars. So those are really our 3 main categories of these service contracts that have specifically identified assets. There are more as we start. We're currently going through expanding our business as well. And as we do that, we kind of add these new categories as we find them. So I think that's really what's helped us. And then we start tackling each of those categories individually. So for instance, on the terminaling arrangements, one of the things that always got us out of lease accounting was substitution rights. So now we're going through the assessment on whether those substitution rights are actually substantive, or whether we need to actually consider those to now have specified assets and be subject to the leasing standard. So that's one of the exercises we're going through. We're identifying the considerations for each of those broad types of contracts. And at that point, we're also bringing in our auditors to discuss our conclusions with them.
And I guess what sort of advice would you give to folks as they start to kick off that review of service arrangements?
So I think the thing is you need to scope in more than you would normally do. I think you need to think broadly first, and like I said, get those categories. For instance, within our terminaling arrangements, we have different characteristics for we have 8 different types of terminaling arrangements. So we've broadly broken them out there, and then we start combining those categories and really trying to dig down to what are really the different types of things we're seeing. And so that's the way we've done it, is we've gone broadly, and then we're starting to narrow scope as we continue to go down the process.
Got it. And I guess we don't want to get too much further into the panel without touching on the new IFRS standard and kind of comparing and contrasting the differences between the IFRS standard and ASC 842. David, I know you have experience with this. Do you mind talking us through that?
Yeah, thanks for that, Jeremy. It's a good question. As you noted earlier, a lot of the key concepts between the standards are the same, but actually the project was first conceived as a joint project between the FASB and IASB. The boards, when their final standard, have actually diverged in a couple of spaces. Most particularly is around the income statement model that's been applied. So as you noted earlier, Jeremy, under the FASB approach, they're applying this dual approach where the lessee needs to classify leases as either operating leases or finance leases. Under the IFRS approach, there's only a single model where you have to effectively, it's a finance lease that we recognise in the books. So the dual model actually, in terms of recognising the initial asset and liability, that doesn't change, but actually it's about how it's differentiating the income statement treatment of the operating lease versus the financing lease. With the finance lease, interest and amortisation expense being recognised, while on the operating leases, a single lease expense will be recognised typically on a straight line basis. Under the standards, the definition is typically the same, so I think that's a good thing. So we're talking leases and leases between the two standards. However, the IFRS, in their wisdom, have provided some additional exemptions which aren't available under GAAP. These exemptions include for short-term leases, so leases that are less than 12 months that don't have a purchase option, and for low-value leases, leases less than $5,000. I'm not sure how valuable that lease less than $5,000 one will be. I guess the key thing is the standards are written very well from an IFRS perspective, and even though you might not need to capture short-term leases and low-value leases in your lease liability, you still need to disclose those items. So in terms of a couple of other key differences between the old and the new IFRS, in terms of the balance sheet and income statement, operating lease classification will no longer exist under IFRS. All leases will be recognised on the balance sheet. So you'll be recognising a right of use asset and a lease liability, which is based on the present value of the future lease payments. And then the right of use asset will be depreciated over the life of that lease, while the lease liability will result in finance costs in the income statement. I guess one of the most significant impacts in terms of adoption, this is actually impacting on the cash flow statement, and this will have significant impacts on metrics. So under the old IFRS, leases were recognised within operating cash flows. However, now that they're recognised as finance, effectively as finance leases, the part of the lease payment that represents the principal portion will be recognised within financing cash flows. And the part of the portion that the payment that represents the interest portion will depend really on the current treatment, but it will either be an operating or financing cash flow depending on the company's accounting policy. Jeremy, as you noted, there is some transition options available. US GAAP and IFRS both allow a modified retrospective approach, which is good. However, IFRS also provides the flexibility to apply a retrospective transition approach, which potentially is more onerous. And all I would say on the transition approaches, particularly for IFRS, is it's not an easy answer. I think it's worth understanding your lease portfolio and then particularly understanding the impacts of applying the different approaches on the opening balance sheet position and then future expenses for finance expense and also your depreciation expense. So it's not an easy answer for that one.
Got it. Yeah, and I would say, and I should have mentioned as well. So the U.S. GAAP also has that exclusion for less than 1 year. So basically, new leases that are less than a year, you wouldn't capitalize it. You would just continue to recognize a straight line as we are today. And then, even though we don't have that $5,000 exemption under U.S. GAAP, a lot of folks are coming up with a materiality threshold, and so ultimately, kind of getting to the same place.
Yeah.
So now that we know kind of the summary of 842 and the summary of IFRS, I was hoping we could talk about, obviously, this is the impact on accounting, but both these lease standards have impacts in other areas. So I was wondering if you could talk about some of the other key stakeholders.
Yeah, no problem. I think really need to step back from this standard, and I think as accountants we need to recognise that sometimes the impacts of standards have broader connotations through our business. It's not just the financial reporting that's impacted with this standard. And what we did when we first started scoping the project was try to understand all the internal and external stakeholders that might be impacted by the implementation. So let me just run through a few as examples, and maybe it's areas that people who are listening can have a think about in their business as they leave the presentation. In terms of the business, I think it's important to realise that there's potentially a significant upfront level of resource requirement to analyse and evaluate contracts, and with that comes a training and education requirement. So you can build this in as part of your staff development programs, but what we've seen is potentially there's very significant impact on resources in the business to actually work through the initial stages and scoping. From a commercial and supply perspective, potentially there's future decisions around buy versus lease. How do we go and negotiate future contracts? Are there opportunities to minimise lease payment, the lease liability, if that's something what the business wants to do? And also there's areas around unbundling of contracts, arrangements whereby you can split out the portion that's a supply, it's a service versus the actual equipment or plant that's being provided. In terms of treasury management, you might, if you've got debt covenants, you might want to have a think about how these changes in the balance sheet, income statement profile, cash flows impact your covenants. Also, there's potential rating agency impacts that need to be worked through, and there's an important piece around communication with those stakeholders as well. In terms of investor relations for the listed companies out there or companies that have a investor relations group, significant amount of investment and time will be put into educating analysts and others around the future impacts on the primary statements, I think. Yeah. And in terms, it can be really broad too. So we've had to think about could there be potential impacts on HR or remuneration? Are your directors or key management personnel remunerated based on certain metrics, EBIT, EBITDA, net cash flow or operating cash flows? These are all areas that I think should be considered. And I think the important thing here is you want to go through the process here and make sure you've got a holistic view of the impacts and not just have a silo-based implementation project.
Right. And so I know a lot of my clients, kind of on day one, they're coming up with they're building a cross-functional team. Obviously accounting and finance, but treasury, real estate, IT, tax, just to make sure that kind of everyone's in the room and engaged that's going to be affected by the new standard. A couple things that have flushed out of that. I've been surprised with how many real estate groups are ready to change their lease admin software. So from an accounting perspective, most companies, with more than, call it 50 to 100 leases are getting an accounting software system. And most of those are also providing a lease admin arm. And so to kind of have those in the same software solution has been advantageous. So I noticed real estate's been interested in that. I know IT, there's a lot of opportunities for automation. And so the IT groups has a lot to offer. And then also tax. I think tax is concerned, at least in most companies we've been with, has been focused around the details that we're aggregating. So we have to go to leases to get, a lot of times we have to go back to leases to get certain information or I should say lease listings. And so tax has specific information that they want to be able to track, because just because the accounting is changing doesn't necessarily mean the tax basis is changing. And so tax wants to be able to make sure that they are able to track both the tax basis and the accounting separately, and to have that level of detail. Stuart, and Christy too, but I guess starting with Stuart, who, for your implementations, who are some of the non-accounting stakeholders that you've included up to this point, and kind of how have you engaged with them?
I think, yeah, good question. I mean, one of the biggest things for us is our net debt. Our net debt amounts. One of the things from a Centrica point of view is kind of our external rating agencies is impacted by things like leases, because it's sort of they count operating leases towards our net debt. So the biggest thing, the biggest area non-accounting stakeholders are Treasury, and probably Treasury is kind of the starting point. I mean, one of the things that we have been sort of looking at is, we talked about using a modified or retrospective approach. And one of the sort of opportunities that we've seen is to actually do a full retrospective, because it actually leads to a lower lease liability, because the interest rates back when some of our real estate leases, the interest rates were relatively high. So that's one area that we are looking to engage, but also areas like our trading team. Our trading team are interested in the opportunities, which we'll touch on later on, as to how to structure certain PPA contracts as not leases, as an example. And probably another area is M&A. When we are going through M&A transactions, we need to look at whether or not there is any sort of debt implications, because that can basically have a pseudo debt implication, and therefore increase the amount of, so you may be paying amount of cash, but there's sort of unintended consequences as a result of having embedded leases without in certain acquisition agreements, as an example. So in terms of how we've engaged them, I mean, we've kind of have a kind of sessions with those various groups to sort of take them through what those standards are and where we think those implications would arise, and get their input into sort of how they see things and how that would impact on their on that particular business unit.
Right. And I heard you said for the interest rate, the management's perspective was to they wanted a lower, their preference was a lower interest rate. And is that just so the day two interest expense is lower?
It would day two interest would be higher, but the sorry, yeah, that's right, that's correct. But basically, what we're looking at is if it's a higher discount rate in the past, if you went to a modified retrospective, you would obviously apply your discount rate at that point in time. But if you had sort of long dated PPA contracts or sort of real estate leases, then you'd have a higher discount rate, and therefore that would lead to a lower lease liability at the time of transition. So that has a positive impact on our net debt ratios. Got it.
Yeah, and I guess that's the trade-off, right? Is the higher your interest rate, the lower the liability, but the higher the interest expense will be kind of in subsequent accounting. Yes. Versus the opposite. I know some companies they're not as concerned about their balance sheet, and so they're looking for where there is an opportunity to have a lower interest rate. They're going for it to say, even though my liability will be higher, my day two interest expense will be lower. So I guess that's something companies should think about when thinking through their interest rate. Yeah. Where's their best interest, and which would they prefer? Because, like you just said, there are opportunities, at least right out of the gate, to kind of manage what that interest rate you're using is. Yeah, and there's definitely a trade-off, because I think with sort of long, complicated leases, it's very costly to do a full retrospective. So it just depends on the sort of cost-benefit balance that's correct for the company. That's fair. Christy, I know Stuart covered a lot. Is there anything else, just from a stakeholder perspective, that you've experienced, in your implementation?
Yeah, so I'm in constant conversation with business development and our trading floor and our plant, because quite frankly, a lot of the operations we do are going to end up with potential embedded leases in them. And so we have lease versus buy versus develop decisions that we're making now. And we also have decisions on how our capital allocation process is going to happen. because in the past, capital leases were part of our capital allocation processes, but operating leases were not. So now, suddenly, with everything coming on the balance sheet and generating what our Treasury Department is going to view as debt from a debt covenant perspective, it suddenly comes into the capital allocation process, and we're having to completely revamp that from an operations perspective. So it is a much, much larger project. So we've actually set up a steering committee. Our steering committee has the finance organization, but it also has Treasury tax, the plant finance lead, and then we have IT and a couple of other folks on there, which we're really having those conversations at that level. And so the project reports up into our steering committee so that we can then raise the issues as it goes. And a lot of what we're doing right now is education and having those discussions, but it is a lot larger than initially I think any of us thought.
Right. So another interested party is our auditors, obviously. And so one of the questions I have is, where are the auditors in each of your implementations, and kind of how involved have they been up to this point? What kind of feedback have you received? I know in speaking to the auditors at my clients, the two things that they're harping on is completeness and that embedded lease review, and then also controls, certainly. Dave, any comments on where your auditors are at?
Yeah, they're involved in the process, particularly wanting to understand the process that we're moving through around completeness, the quality of the reviews that will be undertaking. They will also, obviously participate in some of that review at a later date to do their own procedures, but they are very interested in the communication, the process, the controls in place at this stage.
Christy, what about your auditors?
Yeah, we've gotten ours involved from the beginning. We had some lessons learned from the way RevRec went, in which we didn't involve them at all because we didn't determine that it was going to be material for us, and it wasn't. So they're now going back and testing that, which is a little painful. So we've already involved them when we're making key policy decisions, and if we need to, we're taking it up to national to kind of get the blessing all the way up. We've had some really good conversations with them. They've been really helpful. We're just trying to partner with them so that they can do value add in this perspective, because we know we're going to need their help later on.
Right, and that's a really good point when I think about auditors, getting them involved early, because most of the teams don't have exposure to 842 or the new IFRS standard, and so you will end up talking to national more often than you would normally on a normal audit.
That's
Stuart,
right.
Stuart, anything that we missed?
No, probably we're probably a bit behind everyone else, as it seems like. We've had some conversations locally on kind of high level what the impacts will be, but one other thing is when it's probably self-evident, but when you're reviewing contracts for lease implications, just certainly from an IFRS perspective, is not just to consider the sort of the IFRIC 4 requirements and the I-17 requirements, but also you're doing things like PPA contracts. They tend to be quite long dated, and therefore probably just consider those so the auditors can be engaged in that. Right.
So I think we've spent some time on kind of what I would call phase one of an implementation, which is around scoping and completeness. Once you get into phase two, you start to pivot to collecting data validation, and then kind of phase three with systems. Stuart, do you mind taking a moment and speaking to how you think the new standards will affect systems, technology, and controls?
Yeah, good question. I think certainly from a control perspective, it's certainly when we went through the process, we want to make sure that we had all of our, that all those contracts were complete, that we had a complete repository of those leases to make sure that we can properly encapsulate those. So obviously the starting point would be your leasing disclosure that you use for your annual accounts to make sure, and then sort of having the various conversations with people to make sure that those are actually complete. I think the other control side of it is making sure that the data that you have is actually accurate. That may involve, unfortunately, as we are sort of finding, is that people have to go back into the contracts to make sure that it's capturing, like modifications that have happened in the past, depending on, if you're using a full retrospective or a modified retrospective. And just making sure that data is complete, and that is what we're finding to be a huge exercise. I think secondly on technology, I think it's finding, and I think we're going to touch on that later, but finding the correct software solution that is geared up for your needs. Certainly from our perspective, we've been engaged quite heavily in looking at various softwares that can capture, and act as a repository and actually look at doing calculations themselves.
And that kind of leads us to kind of the next conversation point, which is around, the collection of lease agreements and the extraction of required data. Kind of what are some of the key challenges that the folks are expecting, and kind of how they expect to address them. I know a lot of the companies that I'm working with, they're really struggling with, in particular, foreign locations. And so certainly most companies, at least that I've been dealing with, have been managing the real estate leases centrally somewhere in the US. But then when you get to embedded leases or within service agreements or equivalent leases, to have a trusted contact at each of these locations to help you get that information, and then also then to then get those translated has been a challenge. And so I guess I wanted to kind of get everyone's thoughts on that. Maybe start with Christy. What sort of key challenges you're expecting with the collection of lease agreements, extraction of data, and then kind of how you're planning on addressing them if you've gotten that far.
We have. So we are working with some of our other teams to do the extraction of the data, where especially the leases are in soft form, but a lot of them are scanned and they're old. So to be fair, we've got some leases that are 50, 60-year leases. We're still trying to find some of them, to be frank. Right. And then we have to scan them in. And so the extraction of the data, there are tools out there that'll help you do that, which is great, except for the fact that these aren't really scannable. So we have those problems. I think some of the other problems that we have is just when we talk about numbers, I think we're kind of on the small side of only expecting 500 to 600 contracts that are going to come under this. But that's still a significant amount of time when you consider that 200 of those are terminaling arrangements. And every single one of those is different because every single person has their own format that they use. So it gets to be a daunting task, but what we're doing is we've brought in a consultant to help us do that. And then we have our own team that we've formed that will be doing that, and data entry by people, which always opens us up to issues, but I think that's where we're going to have to start.
Right. And Dave, how are you guys thinking about addressing those challenges?
Yeah, so I guess we're quite broad in terms of our locations. So as part of the original setup, we knew that there was contracts in different locations and different parts of our business. So it was about understanding what centrally sits in a contract management system or other places, and then really tooling up the teams to go out and start the survey. We're calling it the survey process, which is just to go through the arrangements. We should always call them arrangements, not leases, because they don't necessarily say lease on the top of them, but actually going through, understanding any arrangements that involve the use of assets. That included training of the people and the teams that were doing the work, which was actually seen as quite a good development opportunity for our local teams. So that was I thought that was quite beneficial and positive. But really, there's a significant amount of contracts, and the biggest challenge there is just the sheer number. and getting it into a standardized format where you can make an assessment based on what you've got. That was probably some of the key issues.
Right. The other point, and I know we want to get into some case studies and we're running up on time, but I just want to get everyone's thoughts on kind of some, for companies, like I said, for companies that crack probably 80 to 100 leases, generally you would need an accounting software at that point. What are some of the requirements that you've asked of your software providers? Christy, I wanted to start with you.
So I think one of the big ones is when we're implementing the software, we're going through a massive change from a systems perspective. So we wanted something that A, wasn't expensive, B, didn't interface, which I know is probably rare for everyone, but also, and that's because we don't know what the future state's going to look like. We're going through about a 3 to 5 year kind of transformation from a system perspective. And so to spend a lot of money on a system implementation didn't make sense. The key part, however, is that our tool has to go through our IT change management process. Because at the end of the day, whatever the tool we have that we're going to use, our IT team is going to use it. And so that's the key part, is any vendor is going to have to go through those controls that we have set up after significant failures in the past.
Dave, what about you guys?
Yeah, so technology is obviously a very significant factor, particularly on these days of efficiency and looking to automate certain processes. So having technology team involved as part of the stakeholder group and a key driver is fundamental. I think it's important to make sure that cost is a big factor, and making sure you're doing fit for purpose and not over capitalizing in terms of your software package and the level of support ongoing that might be required. But it's also understanding, how can that software help you as part of the transition? Is it able to model out by a click of the button the different transition options for you? Is that to leverage the existing system in terms of contract management system or other factors? And, is there an ability to use analytics that come from, gathering all this data to actually improve the supply or commercial side? Because effectively, what we're doing, you're putting together a huge database of leases, and so is there an opportunity to leverage that to get some commercial value out of this?
Right. And so I guess we thought it'd be helpful to talk through a couple examples, call it case studies, to kind of demonstrate some of the concepts we've talked about up until now. Dave, we thought we'd start with you. I know you're in the middle of an implementation, but what sort of challenges have you identified, and how do you plan to address them?
Yeah, so I think the first one, if people are just starting on the journey, as we talked about earlier, is the stakeholder management. And a lot of the time in these big projects, stakeholder management is fundamental to getting it across the line. And for us, it was about educating the key stakeholders to get appropriate resources to drive the project. So I think that's a very important thing, that you get key decision makers in the room, part of the stakeholder group or the steering committee is really important. I think education of the people participating in the program, is key. We're not all technical accountants, so if you're involving, other groups or other accountants in the survey process, making sure they're appropriately trained and understand the process. Are probably some of the key things. Perfect.
Yeah, I would say for a lot of the companies that I've been working with, one of the issues they've had is that while there is transition policy elections that the companies can make under ASC 42 around not going back and reassessing classification, and not going back and reassessing embedded lease conclusions, the SEC and the FASB have been clear that those elections only apply if you actually perform those tests previously. Mm-hmm. So for a lot of companies that didn't document the classification of let's say equipment, or that didn't go back and look at service agreements for embedded lease under 840, kind of because everyone had the same assumption that whether these had an embedded lease or not, or whether the lease equipment was capital versus, there was kind of an assumption that the equipment was operating. they kind of waived on assessing it, and I think a lot of auditors were fine with that because they bought into those assumptions. So for those scenarios where you didn't assess it previously, even if you elect the transition guidance, you will still need to go back for anything that you didn't assess and assess it for the first time under 840. I think that's kind of a pain point for a lot of companies. And then there's the issue if you do find a lot of embedded leases, do you need to do a SAB 99 review, which is just basically assessing what the impact or materiality of those would have been on your past financials, and really proving out the assumption that everyone had, which was that they would be operating, that the impact wouldn't be material. Christy, I know you touched on a bit on some of the completeness procedures you were performing. We kind of want to get a little more of your thoughts on kind of the approach that you took to make sure that you did have. How did you ensure that you had a complete population of leases and service agreements? Christy, do you?
I'll be on mute.
I was on mute. Sorry, I was coughing earlier.
Okay.
So, yeah, first with our leases, we start with our disclosures for our leases, and we make sure that those are complete and accurate, and our auditors test that, every quarter and every year end. So that's our start from the items that we know are leases. We actually do have a contract review policy in place. Unfortunately, it didn't really start full throttle until 2017. So we do have older leases that are in place that we're going to have to go back and look at. But on our service agreements, it really comes down to, we've taken a broad scoping approach and saying that anything that potentially has a piece of equipment or a specified asset behind it is going to be subject to coming into scope initially. And then we're going to take a look as to whether anything was looked at. So we've touched on terminal agreements, and I keep saying that because those are really important to us, and that's probably half of our what we consider either out of scope but could potentially come in scope because of that substitution language that we've put in those agreements. And so we're assessing those now. I think we have some rail leases that we've previously concluded that were operating leases that now may come out, just because we're going to take a look and determine, do we really even have a specified asset? So we're actually taking it much more broadly and saying all contracts. We have actually 3 contract management systems here at Motiva. We have one that our supply and trading uses. We have one that we use in technical accounting, and then we have one that our CP groups uses. So we're actually trying to get all those into one system now. And then there's always the fun things of, well, what's sitting at the plant, what's sitting at the terminal that we don't actually know about. And so that becomes, we're actually doing a roadshow with the plant and with our big terminals to see what they've got.
Yeah, that's nice to hear that you have 3 contract management systems. There are a lot of companies out there that don't have one.
Guess what? Not everything's in either one in any of them. So there's still stuff way outside of those.
That's great. Well, yeah, fair enough.
Jeremy, David here. I think it's been a good point. For us, really, it's focusing on making sure you're speaking to the people who know the contracts. So it's the supply or commercial teams who are actually doing the contracts. They are a fountain of information, and that's where a lot of our time has been spent, actually holding interviews, saying what arrangements do we have we identified these. That's the process that's ongoing at the moment, is really that interview process and then pulling together the data in like a survey form.
That's a good point. I work with a decent number of biotech companies that are in pharmaceutical companies that outsource their manufacturing. And so same thing where we've had, a lot of times those are contract manufacturing service agreements. So they've outsourced the manufacturing to a company, which is charging them a service fee. And so obviously those fall into that embedded lease assessment and talking to the appropriate people, the facilities folks, etc. You really are able to really figure out whether it is or isn't an embedded lease pretty quickly. Where without them, you kind of have to make some assumptions which may not be correct.
Great.
Stuart, I know in some of our past conversations, you've talked about some of your examples of embedded leases and and other concepts specific to the utility industry. We were hoping you could share a couple examples.
Yeah, I can give 2 or 3 examples. I mean, one of the things that we are finding is we're moving more to sort of cloud-based service arrangements. As we sort of develop our sort of IT function, we're finding that a lot of these cloud service contracts contain embedded leases that we need to consider separation for. On the sort of trading side, on our trading floor, we have a lot of, so we deliver a lot of gas to utilities, and sometimes we get some pipelines that are sort of called lateral pipelines, which may be connected to a wider grid. And the question then becomes, is that a physically distinct asset, and one that you could effectively could potentially be considered a lease? And the third issue is more of an opportunity. It's more around some of our renewable assets. So there's definitely opportunities. So thinking about the definition of a lease, you have to have control and take substantial the output. There's certainly opportunities such as wind farm tolls for those not to constitute leases, where you can take 100% of the output, but you genuinely don't control, because you can't control how the wind farm operates. So there's definitely some of those issues and opportunities that we're seeing as part of the adoption of the leasing standard.
Those are great. So I know we want to save some time for Q&A, but I guess the last thing I did want to highlight was just reassessment events. And so it's a completely new concept under the new guidance under GAAP. Basically, a reassessment event is, I should say, under 840, you establish a lease, and for the most part, you set it and forget it. You set it on day one, and then you're not really remeasuring or reclassifying unless there's a clear modification. And I guess the point I want to bring up is under the new standard, this concept of reassessment events, and so it's certain changes throughout the life of the lease that may require you to remeasure and reclassify it. And so I just wanted to highlight that, and just know that you'll have to establish controls to start to track that on a real-time basis. And I actually, Stuart, did they have something like that for IFRS, for the new IFRS standard?
What was that? Can you say that again?
Yeah, so the concept of kind of reassessment events, where you periodically have to reclassify or remeasure your lease liability based on kind of changes in assumptions that you had at the beginning. I just want to know if you knew if they had that under the IFRS standard as well.
Yeah, I think they definitely do, yes. Okay. Somewhat.
So I guess at this point, maybe we jump to Q&A.
All right. It's Sasha talking to you all from here. Pranita and I have been kind of curating some of the questions that have come online, and we've got some other questions that we wanted to also plan for when we were getting this panel together. So I'm going to go through a couple of the questions that we're getting from our online audience. So Mike Dexter-Smith, who is our ACAUS president, sent us our first question. So his question is, can each participant give us an idea of the resources that have been consumed on this new lease statement? It seems rather onerous. So
maybe we start with Christy.
Yeah. Sure. So I might be under a little bit of a different scenario than everyone, because we're actually implementing both standards because we consolidate under IFRS and standalone report under US GAAP. So from an internal team perspective, we have a 100% dedicated team that's about 3 or 4 people. And then we have a big 4 team that's coming in. And when we talk about resources, that's around the $1 million range. And that does not include system implementation. That is just the assessment and getting ready for day one, bringing everything onto the balance sheet. The system will come later. we are putting into place kind of a standalone cloud-based tool that will allow us to actually manually, it does calculate our entries, but it's not a full-blown system implementation like some of the ACAUS or the power plant or any of those type of larger systems that are out there are.
Dave, do you want to go next?
Yeah, I'm happy to. The answer is a lot of resources. We've got a separate, I guess, project management office with a project manager and supporting team members, teams assisting with modelling, bringing together the work that's ongoing out of the different regions. So you've got teams of the regions reviewing contracts as well. You've got separate teams looking at technology. I don't know dollars, but it's certainly a project that is having a significant impact and is getting a lot of focus. So it's taking a credible amount of resources, yes.
Stuart?
Yes, same as David. It's we have significant amount of resources that it's taken up, and we're like Chrissy, we've engaged an external firm to have a look at the impacts and look at opportunities for Centrica. Yeah,
I can tell you, it varies on my clients depending on how many leases they have, ranging from one lease all the way up to tens of thousands of leases. And so that being said, I would say every single client has a dedicated accounting team, which is usually called 2 to 4 people, dedicated IT person or team, and then are engaging a software provider, which lots of times those software companies at this point are starting to outsource those implementations to consulting firms or Big 4 firms. And then that's kind of the systems side of it. And then also from an accounting point of view, whether they're using CFGI or a Big 4 team or both, depending on how big the implementation is.
Thanks, you guys. That's great. We've got another question here from our audience. This question comes from Kelly. Kelly's given a little bit of background here. She said, we're a heavy infrastructure environment and as such are implementing a robust asset management program in part due to federal regulations. I would be interested to if any of the panelists have a similar program and how these new assets on their books might impact those programs.
I guess starting with me, no one comes to mind, or we haven't got to that point yet. Christy, Dave, or Stuart, have you run into this?
No, I haven't.
No.
Oh.
Sorry about that.
Yeah.
Sorry about that. We'll maybe get some further research down the line, and Kelly, you'll have some other information to help you out with your own resourcing there. Next question, we've got another big question here from Mike again, and his question is, has the effort on leases resulted in any business process changes? Are leases being considered in a different business light?
Yeah, and I know we touched on a couple. The one thing I would say is I would say almost every single one of my clients is starting to think about how they negotiate contracts or I should say leases, and based on the new guidance, kind of figuring out what direction they want to go based on their preferences. Now that the operating leases are on the balance sheet as our finance leases, that there's a lot of nuance in lease agreements that probably doesn't make sense anymore, where folks are trying to get to an operating answer just from an accounting perspective, whereas now that's less important. But there are other nuances that folks are going to want to build into the leases and service agreements for that matter. Whether it is in a service agreement to get away from an embedded lease, or in a lease agreement where you're trying to get either finance or operating, depending on whether you're whether you want that expense to go through operating or below the line. Dave, did you want to chime in on that as well?
Yeah, I'd say there's a significant amount of work being done on process, particularly in a SOX environment. Obviously, there's the implementation, but then how are you going to put this all together once we're up and running? particularly in IFRS around the remeasurement of particular leases at certain times, you need to have a process. It's not set and forget, so you've got to have a process in place to refresh that over time. So yeah, there are some significant process changes, and just from the accounting perspective, but in terms of a business perspective and capital asset management, items hitting the balance sheet now, so they get a different focus to what they were previously, as was pointed out. So, this is all going to be built into how this project impacts more broadly in the business. So yes, there'll be a significant amount of focus on the process.
Right. Dave, anything to add? Oh, I'm sorry, Stuart.
Stuart, yeah.
There's probably, from our perspective, there's definitely a lot more focus on embedded leases, which may or may not should have been there before, but certainly there's definitely a lot, certainly from here in Houston, there's a lot more focus on that. And similar to David, the opportunities to structure are probably more prevalent now, just because there's so much upside if you structure correctly.
Right. Chris, anything else?
Same thing. I mean, it all comes down to, again, some of these old service contracts that we were completely outside of the standard suddenly could come in, and how that is done from an internal process could completely change. I know for years we kept telling folks that were negotiating agreements to put substitution clauses in it. Those substitution clauses don't really matter anymore unless you can substantively prove that they actually will go in and do that for whatever reason.
Right.
So that no longer becomes a negotiating issue. There's some other things that may come back out. I know we were really focused on trying to get things not to be leases at all, but I think that's where some of this focus comes into the control issue. So now educating everyone on what control is versus the old gobbledygook language that was in the standard is completely different.
Right. And that's a good point, I think, with embedded leases, is if you pass all the other tests, I would say the most difficult hurdle would be, or kind of you get out of jail free card, is that control language.
Right.
Thanks, everybody. I'm going to throw up, I think, one that's an easy one because it's a fact here. We've got Fatima who has asked, can we confirm the date the new standard will be effective for not-for-profit organizations?
So I can confirm US GAAP, it'll be January 1, 2020.
Okay, that's great.
And then Stuart or Dave, did you want to add for IFRS?
I didn't think there was a difference in the timing.
Okay.
Okay, fair enough. We've kind of covered the questions that we've been asked through our online attendees, and we've got only about 2 minutes left. So instead of asking, another specific question, if there's any quick closing comments from the panelists, this would be a great time to do so. If not, I'll close off the session in a second here. No, looks good. Well, we're just about at our 1 hour mark, so I'll close it down. I did want to say thank you very much to our expert panel for their insights and their participation. It's been a really informative and relevant session to many of our members and other online audience members as well. Thank you all online for joining our webinar. As we mentioned earlier, we are rolling out an education plan which will be offered as webinars to all our members, focusing on a variety of professionally relevant topics. I'll be sending out a feedback survey in a couple of days, so please do respond to it and give us any queries and comments. We're just, everything we can do to make these sessions better deliverables for you all would be helpful to know. Also, as I mentioned, we're sending out a certificate of attendance that'll be distributed following the session. So please check with your respective accounting body to determine this session's eligibility as credit towards your CPD. So thank you again. We look forward to having you join our next webinar. We're planning to continue our sessions on technology and the profession in May, so keep an eye out for notifications on that as well. And with that, I think we will say good night and thank you again all for your participation and attention this evening. Thanks, everyone.
Thank you.
Thanks.
Thank you.
Okay, bye-bye.